Hi guys. Today we will analyze Union Pacific stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. Also recent evolutions are not positive. The short-term trend is negative, while the long-term trend is still positive. It is advised to wait a little bit longer to see how this turns out. Strong support levels are around $213 and $198. Next strong support levels are around $188 and $173. Strong resistance level is around $229. Next strong resistance level is around $247. In the last month the stock has been trading between $210 and $233 range. It is currently trading in the middle of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 3 million. This is a good sign as it is always nice to have a liquid stock. The stock has been in a downward trend since April 2022. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 2% per year, for last 5 years. We see that the average profit margin of the stock has been around 32% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 82% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Union Pacific Company: bad, average, and good. First scenario. Union Pacific will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, 4%. Future profit margin would be a low, 26%. Future free cash flow to net income rate would be a low, 60%. In this case, the fair value of the stock today would be $102. Second scenario. Union Pacific will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 6%. Future profit margin would be average, 26.5%. Future free cash flow to net income rate would be average, 70%. In this case, the fair value of the stock today would be $131. Third scenario. Union Pacific will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 8%. Future profit margin would be high, 27%. Future free cash flow to net income rate would be high, 80%. In this case, the fair value of the stock today would be $164. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 10.53. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Union Pacific, analysts forecast growth rate around 6% per year in next 5 years, and future P/E around 19. Again, I will use 3 different scenarios for Union Pacific Company: bad, average, and good. First scenario. Union Pacific will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, 4%. Future P/E would be a low, 15. In this case, the fair value of the stock today would be $95. Second scenario. Union Pacific will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 6%. Future PE would be average, 17. In this case, the fair value of the stock today would be $128. Third scenario. Union Pacific will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 8%. Future PE would be high, 19. In this case, the fair value of the stock today would be $170. As you can see, today the stock is overvalued, $221, even if we expect the company's high performance in future. While the company has a great profitability rating, there are some minor concerns on its financial health. Also, the company is expected to show a small growth in the next 5 years, 6 to 8% yearly. Based on that, the stock looks overpriced at the moment. I may consider buying the stock for the dividend, when the stock drops below $165. Company's strengths. Union Pacific provides rail transportation services in North America. It has approximately 32,000 route miles, and transports agricultural goods, automotive products, chemicals, coal, industrial products and other commodities between ports on the West Coast and eastern gateways, as well to Mexico. Union Pacific has been the backbone of the U.S. economy for several decades, and that will continue to be the case for the future. The company continues to be in a good spot to improve its earnings, despite economic headwinds. Compared with trucking, shipping by rail is less expensive for long distances, is 4 to 5 times more fuel efficient per ton-mile shipped, and generally has ample capacity. Union Pacific has a rock-solid business model that allows it to generate good growth. The company's return on assets of 11%, return on equity of 57% and profit margin of 30% are amongst the best returns of the industry. The company has been rewarding shareholders nicely through increasing dividends and share buyback. This trend will continue into the foreseeable future. Risks. Risks includes the war in Ukraine, the COVID-19 pandemic in China, where so much of our imports come from, and inflation. Railroads are also highly sensitive to the macroeconomic environment, and are subject to risk from fluctuating fuel prices, fuel hedges, bad weather, strikes and other labor actions. Union Pacific lowered its operating efficiency estimates, as it continues to struggle with supply chain problems and inflationary headwinds. Like its peers, the railroad needs to improve operations to service demand. The company also faces risks related to government regulation, and may incur extraordinary costs related to positive train control systems, the transportation of flammable liquids, and braking standards. The company has a pension plan, which is not fully funded. The company is not financially healthy enough and could expect problems in meeting its short-term obligations. The revenue is expected to grow only by 6 to 8% on average over the next 5 years. The earnings per share is expected to grow by 8 to 12% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.